This is how mortgages are built to win against you. Today I'm going to be talking about mortgages and why they are built to win against the average consumer. Hey, my name's Dave from Investor Mel and Dave. My wife and I have now purchased over 240 units in 5 different countries: Canada, US, Costa Rica, Mexico, Dominican Republic. We specialize in doing this with creative financing and other people's money. We were able to quit our full-time jobs in our 30s, and we now show people how to do this just like we do with our Action Family Mentoring Program. If you're not following already, please make sure to subscribe to the channel and make sure to hit the bell to get notified as we drop a new video every week. All right, so let's dive in. Now today I'm going to be talking about an average typical mortgage with a 25-year amortization rate. Now, I'm not against mortgages. I have tons of mortgages. I owe tens and tens of millions of dollars of mortgage money. I love mortgages. I love other people's money, and I love good debt. Now, that being said, I just want to explain to you how the mortgage loop works and how it's really not built to benefit you. Asterisk here. If you're using mortgages for income properties, obviously there's going to be more advantages instead of if you're just using mortgages for your principal residence. Now that's just my opinion. Okay, so let's build out an average mortgage. Let's say it is $500,000. We're going to give it an amortization of 25 years. And amortization is basically how they calculate the debt over that period. So for example, if you're borrowing $500,000 over a 25-year period, this is what your debt structure would look like. And in this made-up scenario, we're going to have a monthly payment of roughly $3,500 principal and interest. So now let's really break it down. At the end of year 1, you will have paid just over $42,000 in payments. From that $42,000 payments made every single month, principal and interest, $34,450 roughly will have gone interest only, meaning out of the $42,000 that you paid that year for principal and interest, just over $7,000 only actually went to the principal. So think about this. In that $500,000 mortgage that you have, $493,000 at the end of year 1. You didn't really put a big dent in it. Okay, let those numbers sink in a bit, because this is exactly how mortgages are built. Yes, they're going to calculate it over 25 years. However, the bank is going to pay their interest in the beginning. The lion's share of the interest that you owe that financial institution, that mortgage holder, will be paid in the first few years. And if you're starting to see what I'm going to be talking about today, you can start to see why the mortgage works for the mortgage holder, not necessarily for the person taking the mortgage. Now let's fast forward to year 5 of this same mortgage. The same $42,000 has been paid in principal and interest after year 5. In those 12 months of year 5, roughly $32,000 went to the interest, and just over $10,000 went to the principal. So at the end of year 5, your principal amount remaining would be roughly $455,000. Now some quick math here. If you paid roughly $42,000 a year for 5 years, you would have paid just over $210,000 in total. Out of that $210,000 that you paid in 5 years, only $55,000 went towards the principal. The other $155,000 all went to interest. And I'm telling you this just to make you aware. Now, again, I love mortgages. I love debt. I don't mind paying interest. Today's video is all about showing you why mortgages are set up for the financial institutions. Okay, so just for example purposes, with this same mortgage, if you were to fast forward to year 15, you would now start to break even, where $21,000 would roughly go to interest payments, and the other 21-ish would actually start going to principal. So at year 15 is when you kind of start to break even with principal and interest. Before then, the lion's share again continues to go to the interest, to the financial institution. So let's pause here, okay? So now that you understand the concept that they get paid first and that your principal really starts to build up at the end of this 25-year term, for example, this is where I want to take it up another level. So in those first 5 years, this is when you pay the most towards interest and the least towards principal. What does the normal family typically do every 3 to 5 years? Typically the market goes up, even if there's a little bump here and there. Typically over 5 years, your asset will go up in appreciation. And what do you end up doing? You go back to the financial institution, doing, get a new appraisal, get a new refinance, which a refinance breaks that existing mortgage and gives you a new mortgage. So just when you were at year 5 and you were going to start to make a difference in regards to the interest and the principal, you renew for another 25 or 30-year amortization. So you see how if you do this every 5 years, the principal and interest continues to stay in that financial institution getting the lion's share, especially the first 5 years. And this is where people get in the cycle of they never end up paying off the property because every time they renew, it goes to the interest. So just to really differentiate things here, when we do this for our income properties, I'm completely fine with it. Because every time you take a refinance, you end up taking that money and going to buy another income property, right? Your money makes other babies, makes other income properties, which is fine. That's how Mel and I have scaled our portfolio. We do this at another level because we use other people's money on top of the money that we get from our assets as well. The issue is when you are using your money for your house or your residence and you refinance and you go buy consumer goods, and you keep upping that mortgage amount while not having more equity in the deal. This is where I see people have an issue, and this is why I see people thinking, oh, my property, my house, my single family dwelling, or my principal residence is an asset. Well, no, it's not, because if you keep taking money out and keep paying the bank a lot of interest on it, eventually it'll never be paid off, right? So that is the cycle, the loop that people get into with mortgages. This video was just for informational purposes only. I'm not saying don't get mortgages. I'm not saying don't buy your house with a mortgage. Again, we have our house with a mortgage. I'm just explaining that people think refinancing a property continuously over and over again doesn't have any consequences. I'm just here to show you that yes, you can refinance and pull out the equity and do something with it. Just know that the way mortgages are, they are skewed, again, like I've said it numerous times, to pay the financial institution first. Hey, so if you like this type of video on financing and income properties and mortgages, make sure to check out our next one. I'm Dave and I'll see you there.